Thanks for joining us. It's such a pleasure and privilege to have with us today Don Yacktman, President of Yacktman Asset Management. Don, welcome.
Thanks. Good to be here.
Such a pleasure always to speak with you. There's lots going on in the world today, and these interviews perhaps start with asking you about your current market observations, but I really want to step back and ask you first if you could tell us how you really got motivated to go into investing.
Well, it's interesting because that ties in a little bit to some of the earlier parts of my life. I actually started out because I'd grown up in the Sputnik era and being good in math and such, being encouraged to be in engineering. And then I went on a mission for my church. I'm Mormon, Latter-day Saint. And after 2 years of being on a mission, I said I wanted to work more with people. And I came back and started looking at different things. And one of the things that I really liked was my father had started to invest, and I was really fascinated by that. And I also happened to look at my interest exam, which was given before I went to college, and I noticed I only had like a 32 on engineering as percentile, and my business one was like 92. So I thought maybe there's a message here. But by the time I was certainly a senior in college, I was really had investing in my blood. I'd been doing some on my own small way, and really was pretty ingrained.
Now, tell us a bit about that mindset that it takes to be a successful investor. It seems to me that there's a lot of distraction out there, perhaps increasingly so over time. Could you talk about how investing has changed over time, over the decades that you've been in the business, and what sort of mindset is required to be a successful investor?
One of the things that differentiates us with so many investors, I think, is our time horizon. And I think investing over the period of, say, 40, 50 years has become more of a casino mentality. I think the combination of a decline in trading costs and a society that becomes more snippet and so on, the CNN kind of, or I mean the CNBC kind of mentality of wanting these quick, short kind of things, I think tends to accentuate that. And so I think the investment experience for most people, they're really not investors, they're really sophisticated speculators or just plain speculators. And the turnover rate has increased dramatically as a result of that. Whereas I think that having a long horizon time, a long focus, will bring better results because, as you know, the quote is that in the short term the market is a voting machine, in the long term it's a weighing machine. And I think that is a valid comment.
Now, when you look at the investing environment today, what is perhaps important for you to take account of with the mindset that presumably doesn't change, the principles don't change over time? However, what are you emphasizing in today's market environment, or what are you paying attention to perhaps a bit more than you would normally do?
Well, I think we've evolved to looking at forward risk-adjusted rates of return. We feel that's the most objective way of analyzing an investment. And while no one can predict the future with certainty, trying to use that formula, if you will, by in effect leveling the playing field of all investments as though they were bonds, whether it's a bond or a building or a stock, and looking at forward rates of return and then adjusting them for the risk allows you to be very, very objective. So we think that's the better way to go.
And when it comes to that mindset, you've spoken a lot about looking at everything as though it were a bond. Could you explain how that really affects your thinking about riskier assets, about equities?
Okay. Basically, what we'll do is, well, let me talk about it this way. Any investment, you lay out the money today and you have future cash flows coming in from that investment. Typically in a public company, one of those is through a dividend. When you buy the stock, you know what the dividend is, and based on your historical experience, should have a reasonably close, accurate assessment of what the reinvestment rate on that dividend is. So the wild card in investing is the money that's retained at the corporate level and reinvested for the investor by the management of the company. That usually is still the bulk of the cash flow. And so to some degree, in effect, you're franchising, you're entrusting that money to the management to do a decent job on a reinvestment rate. And any time you're projecting out in the future, there's going to be a range of outcomes because, again, nobody can predict it with absolute certainty. So the more predictable the outcomes are, the higher the quality becomes of your valuation process. And the lower the quality, the more risk there is in either financial risk or economic risk, the range of outcomes will become wider and wider. And so one has to take that into account in trying to assess the rate of return hurdle that you feel is adequate to justify an investment. The business model, we think, is also important. So because the business ultimately boils down to what you buy and what you pay for it. And on the business model side, if you were to draw a grid and one axis be fixed assets, the other be economic sensitivity, you could plot any company. And the reason we look at it that way is because what we're really looking for are businesses that can earn high returns on tangible assets. The central tendency is for those kind of businesses to be businesses that have low fixed asset components and low cyclicality. So like 3 of our top 4 holdings right now happen to be Pepsi, Procter & Gamble, and Coca-Cola, all of which fit that profile. They're in effect like our AAA bonds. And as long as you can buy them with an adequate rate of return, those become excellent investments. And then you start to look at lower quality things based on the predictability of those cash flows.
And when we think about it that way, where it starts with the, let's say, 30-year US Treasury rate, and then all the other available assets in the world get sort of priced off of that, could you talk to the challenges for an investor when that benchmark, when that thing that sets everything else is perhaps manipulated or artificial, as some have suggested?
Yeah, and that's a good question. If you look historically, like right now we're hitting the 100-year anniversary of the Federal Reserve System. And over the last 100 years, we have averaged 3% inflation. So $1's gone to a nickel roughly. In the last 50 years, it's been 4%. So it's accelerated slightly. Now, at the current time, we're below trend line in the sense that or you could maybe say we're driving the trend line slightly lower by coming back to closer to 3%. But whichever number you use, I think it's dangerous to project out inflation rates that are substantially below those kind of long, very long-term numbers. Well, if you take that and look at it, the long-term bonds have had a central tendency to sell at about a 3% premium to inflation. And so that puts you at the 6 to 7% level, and equities another 3% over that, so you're up at the 10% level. And in fact, if you look at the 50-year numbers, I think you'll see that with inflation at 4, I think equities have been a little over 10. So those numbers hold pretty close. The problem is those are 50-year numbers. 1-year numbers are going to vary dramatically from that. But the bottom line is that I think it's dangerous to have a hurdle rate based on treasury bonds that are 3% or 3.6, whatever. In the last like 15 months or 18 months, they've gone from I think 2.5 to 3.6. I think those are well below historical numbers. And I think that's one of the dangerous problems today, is that because you're looking at numbers that are way below historical numbers, and I think it's driving equity values to much higher levels because people are basing it off of current rates of long-term treasuries rather than probably trend line or reasonable rates.
Now, you've talked about looking for escalators as an investor. Do you feel that that approach, looking for great businesses that are creating value over time, is perhaps in the current environment of such low interest rates, does that suit you even better? Does it help protect you against inflation in better ways than some other investments can, even if they weren't attractive in and of itself?
Yeah, there are two elements that strike me with that question. One is that, yes, and I'm a conceptual thinker, so we think of them as like beach balls being pushed underwater with the water level rising. And we'd rather own the escalators than the moving sidewalks. In other words, businesses that are building underneath, building value at a more rapid rate. Again, it all starts with price. Price is the real key determinant of any of these. But if you can, the more you can buy better businesses at a good price, the better off you are than buying poorer businesses. Today, because we've had a cyclical upturn in the economy and profit margins have increased for the more cyclical side of the economy, I think what's happened is that the spread between the really high quality businesses and the lesser quality businesses have narrowed. In other words, just like the premium for a lower quality bond is too close to where it is for a high quality bond. So today, as we look at the market, we think the best values really are in the very high quality market area, and that you're really not being compensated adequately to take on a lot of additional risk.
And it almost seems a bit ironic that these types of investments, the great businesses that have great reinvestment opportunities, are available at more attractive prices than other types of businesses, given that interest rates are so low and there is this potential for inflation down the road. Do you agree with that, and why do you think that's the case?
Well, I think another thing has been that in an environment of a weak economy, these companies have tended not increase their prices as much because they want to maintain market share, and they've had a little bit of pressure on the cost side, and so their profit margins have been squeezed a little bit, and so they've looked a little duller from a rate of growth standpoint, and people are not very excited about them. They're not a high unit growth business in many cases. They just have enormous market shares. And so I think they become a little bit like dull as dishwater, and they have lagged the S&P on top of that for the last 3 years. And so when you have a situation like that, people tend to move away from it because they're rear view mirror investors, although driving a car looking in the rear view mirror doesn't usually work very well. But because of that, I think they aren't as excited, and so they're moving away in a lot of cases from them.
Am I correctly reading into this perhaps some latent pricing power that's available with those businesses that perhaps the managements are not looking to exploit in the near term, but you have confidence that they do have that pricing power to not only keep up with inflation, but even more so, perhaps, down the road?
Yes, I think that's well said. And I think that at some point, things tend to come more into more of a normal pattern. And yes, the pricing power is there, and I think will come back as the economy comes back.
Now, you have stated that your investment goals are first, to protect the client's money, and second, to grow the money.
Mm-hmm.
What are the key investment considerations when it comes to protecting money?
Well, protecting money means, in our view, means avoiding making dumb decisions, permanently losing the capital you have. But at the same time, we also feel somebody needs to be proactive because of that historical inflation rate. You'll get eaten alive if the money is just put under a mattress. So it requires being proactive and investing to the degree that you can find opportunities that exceed your cost of capital. So that's how we protect. On the growth side, we want to have the best risk-adjusted forward returns we can, with the goal of beating the S&P from one market peak to the next market peak.
Now, when you say that, one would perhaps think about how that imparts on your security selection. However, could you speak a bit about the role of portfolio management as well when it comes to these goals and considerations?
Well, in our view, what it leads to is a pretty concentrated portfolio, because we're looking for the outliers, if you will, the ones that are not are in the tail, if you will, of the so-called bell curve. Although I'm not sure it's always a bell curve, but the ones that stand out. And so, the more money one can pack into the top 10 or 15 ideas, the better off we feel you are. And ironically, taking less risk as a result than more risk. Although most people see that as a risky approach, we see it as a less risky approach. But it's clear that one needs to understand the concepts of risk-adjusted forward returns and understand the business model and the price, because again, it's what you buy and what you pay for that the business boils down to.
Are these considerations different when one thinks about the short term versus the long term? Is there anything an investor needs to think about differently, let's say over the next couple of years versus thinking about the next 20 years?
Well, I think the horizon time needs to be a very long horizon time to use the approach we do. And the one thing that comes with that is a requirement for patience. Because we will, because of our goals and our process, we will not beat the market every quarter. We will not beat the market every year. We're looking at a peak-to-peak cycle, and again, trying to both protect and grow the client's money through that whole cycle process. So, but we think the long term is very important. Yeah, I think the danger is that one can end up churning their wheels if they start to look at really short-term kind of phenomenon. And unfortunately, most people can't look beyond a 1, 2, or maybe occasionally 3-year time frame. It's very difficult for, I think, for investors to have that kind of patience, and particularly because most investors are not as sophisticated. They don't understand the process. They look at the world and you get bombarded with news media about, you know, the danger of this or the danger of that, as opposed to really taking into account the whole allocation process and what it's all about.
I do want to go back to the bell curve that you mentioned, and you've stated that in very disruptive periods, typically the tail of that bell curve gets elongated and there are more opportunities. So am I right in understanding your approach then, when the times are not particularly disruptive, you are usually better off with the high quality businesses that you've been investing in as of late, versus when there is a very disruptive period, then you may be rewarded by looking elsewhere. But usually it's tough to beat the risk-adjusted returns that are available from the likes of Coca-Cola and Procter & Gamble and so on.
Yeah, I think what happens is that there is a central tendency for the more defensive things to look better in those kind of periods that you talked about, the later stages, if you will, of a cycle, because they're kind of lagging usually, and people are getting more excited about things that are more dynamic, and so they end up working out that way. But the key is to be totally objective, and there really are 3 different times where opportunities tend to present themselves. Just like the yields go up on bonds when the price comes down, we see the same effect happening in stocks. It's just that stocks sometimes come down for right reasons. too. I mean, but anyway, the disruptive periods are, and the one is the massive one where you have the market decline like in an 08-09 period, and that creates enormous amounts of opportunity. Then you have a situation where something hits an industry, like for instance a dramatic change in healthcare, and so you'll see many more opportunities in a period of disruption because of an industry situation, or the unique disruption because of some event that has occurred at a company level, but it's singular to that company. But in each case, it's a matter of objectively looking at the opportunity at the headline of disappointment and saying, at what price are we willing to own this business, and trying to be objective about it and looking at the forward returns.
So it really does go against this common notion that people throw around that term of safety, and they want to look for safe investments. What you've just described is really, when it comes to idea generation, going to where the trouble is, where the uncertainty is high as a source of opportunity, where others really try to avoid uncertainty as investors.
I think it's a time horizon issue. What people view as uncertainty may be an uncertainty in the short term, but may not be as uncertain in the long term. But yes, people get scared because of short-term events, and the market tends to be this manic depressant. It tends to be kind of disruptive. An average stock fluctuates about 50% from low to high in a 12-month period, but occasionally you get these outlier kind of situations, whether again for a company, an industry, or the market as a whole.
Now, with the approach that you've employed so successfully over the years, what would you say is the most difficult aspect of it?
Well, I think the most difficult aspect is to totally understand decision making by managements. The managements, what we have found is that you like to look at their history and what decision making process they go through. They really have about 5 options. One is put the money back in the business, R&D, marketing, cost reduction, distribution. And if you have a big market share, marginal unit growth can provide enormous rates of return on incremental unit growth. So that's very important. But the companies, after their infancy, start to generate excess cash, and so they have to examine 4 other options. One is the dangerous one, which is acquisitions, because too often the ego overrides the economics, and this is where it gets scary. The third one, is share repurchase. At least you know what you're buying. But again, in both cases, it's do they have discipline and price. The next one is letting the shareholders have it back through a dividend, and the last one is just sitting on it. And how they behave, we have found, is much more important to know than what they say they're going to do, because sometimes there's a gap between what they say they're going to do and what they actually do. But one needs to take that into account. As an example, years ago, or a few years ago, we had a much smaller investment in Hewlett-Packard than we would have had, just because we were very nervous about their capital allocation process. And they actually exceeded our worst expectations with the autonomy acquisition, where they, in our opinion, grossly overpaid for it. So those are the kind of things that kind of become surprises in a negative sense. They can also be a surprise in a positive sense. In the case of News Corp a few years ago, when they wanted to buy the rest of B Sky B, we were a little nervous because we were worried about them overpaying. And then, of course, the British Parliament got unhappy with them and prevented them from doing that. And so they had to go to Plan B, which we liked better than Plan A, which was buying back their stock, which we thought was a much better use of cash based on the price of the stock. And so they moved to that, moving to that way, and it ended up being a dramatic plus from what our expectations were.
Given that you allocate such importance to the role of management, could you tell us a bit about, have you ever been tempted about just following the jockey and perhaps compromising on business quality and price considerations, believing that management is really the right one, and that's sort of the key to the investment thesis.
And that can happen on occasion, but it's rare. I mean, I remember back when I ran Selected American, buying some fireman's fund because of Jack Byrne, as an example, where I had a high degree of confidence in Jack Byrne. But it took him years, much longer than I'd anticipated, because basically what he had to do was move away from the business model he had, which was less than stellar, to try to improve the business model and to take advantage of the values, the underpricing of the model. So, you know, what I guess I'm saying is the ideal thing is to have a good business with a good manager and a good price, obviously, to go along with it. It's a lot easier when you have the wind at your back than you have the wind at your face. Good managers generally will change the wind direction. But as investors, you know, you can control the sails, you can't control the wind. So you become much more dependent on it. So I'd rather see the machinery humming than the machinery just littered and not doing much.
When it comes to management, would you be able to give us an example of a CEO, capital allocator that perhaps is underappreciated by the world in how they go about business, and it would be a good example to study to really understand how to think about management and what to look for as an investor?
Depending on time frame, I think going back years ago, when it was still a public company, I thought Bill Sturritz, when he handled Ralston, did a great job. He started with a company that before him had diversified. He shrunk it to its most profitable core, grew the core, bought back stock, I think did so many things correctly. So I think that was a sterling example. I think the one that stands out in the last maybe decade or so, and partly because it's so heavily family owned, is Lancaster Colony, which is a smaller company. But I think they've shown incredible discipline in capital allocation, gradually moving into better businesses, and being very careful. We vote against every stock option plan. They had virtually no stock options. They're very careful that they've done special dividends, they've done share repurchase, they've done an awful lot of things right.
Now, if we think about investing and approach it from various angles, you've kindly told us when we last spoke about how one of your sons came to you and explained investing roughly, meaning buying above average businesses at below average prices, and on average that's going to work. And it reminds me a bit of Seth Klarman's quote when he says that value investing is simple to understand but difficult to implement. The hard part is discipline, patience, and judgment. Those three words, and you've mentioned patience earlier in the conversation today, would you tell us a bit what that means to you, discipline in investing?
Well, I think discipline means to continue to have a process and utilize that process over and over again so that it becomes a repetitive thing because you have confidence you've developed it. There's no substitute for knowledge and kind of grinding it out. I know my son Steve, who works with me, was talking to a group at a college, and a question came up about a company, and he said, well, have you read the 10Ks and the 10Qs? And they kind of looked baffled, as you know, like as though that was some surprise. And he said, I do. So, I mean, I think a lot of this is just digging it out and really understanding the business model and understanding all the nuances. Clearly, we're never going to know the company as well as the management knows it because they're insiders. They see it every day. But really trying to understand it. And so it does become kind of a grinded out process.
Speaking about patience, how do you develop patience as an investor? How do you nurture it? How do you withstand this noise that tends to shrink the time horizons of most? What's sort of a good medicine to withstand that pressure?
Well, it's interesting. When we were in downtown Chicago early on, we'd get a lot more bombardment from people because our accessibility was there. When we moved to the suburbs, it dropped off dramatically. And I think the less noise one gets from Wall Street, the better off you are. Now, that doesn't mean we're going to move to Fiji. But moving to Austin even reduced it more because there are fewer people that come through. And so I think it's important to step back and not get caught up in the 24/7 news cycle and just turn off a lot of that stuff. Just avoid it and concentrate. Yeah, I've commented that our office sometimes comes across more like a library than it does a trading desk at a New York brokerage firm.
What about the word judgment? What does that mean to you, and how should an investor understand the meaning of good versus bad judgment and go about improving on judgment over time?
I think, to me, that means objectivity, really thinking through the process and being as objective as one can, recognizing that in our business, we're basically wrong almost all the time because nobody buys everything at the bottom and sells everything at the top. So it's a matter of getting used to recognizing that. That doesn't mean we can't be well above average, but there is a degree of probability in this, and that recognizing that we're all human and we're going to make mistakes. And don't try to defend the indefensible. When one makes a mistake, admit it, learn from it, move on, and try to improve on what the mistake was so that we don't repeat it over and over again.
To come back to these escalators, as you refer to them, how do you judge whether a company has a moat and the sustainability of that moat?
Usually the moats come as a result of big market shares, which ultimately what it amounts to, I think, is a low cost position. In other words, you can get a moat, say if you're a mining company, because you find a vein of some particular product or commodity, and it's right at the surface, let's say, you just happen to luck out, and it's just real cheap to get at. That can happen. But I think the majority of the time, it becomes a result of just doing correct big business principles, continuing to make the product better, and not compete on price, but on quality. You make the quality better, and so as a result of that, you start to get more sales, which then in turn gives you a chance to drive down the cost because of the experience curve. A company that has a 40% share of a market doesn't make twice as much as somebody that has a 20% share. They'll make 4 times as much. And so, but in the process, one needs to bring down the price to benefit the shareholders, or not the shareholders, but the consumers, and expand the market. That's one of my concerns about Apple, is that whether they've held up their pricing too much, creating enormous profit margins that are simply unsustainable. Better to give up some of the profit margin and build such a strong position that it's very difficult for other people to attack your position.
And would you say, if Apple represents that one side, the Coca-Colas of the world, or specifically Procter & Gamble and let's say Pepsi, they have they're on the opposite side, is that right? Where you feel that they're perhaps not optimizing the price recently, and they have this potential to do a better job at extracting more profits over time?
Well, I think it's a combination of two things. One is, in the case of the Cokes and Pepsis, is that their businesses are a little bit more mature. They're a little more like cash cows, so to speak. But as once you've established an enormous position and the business has matured to the point where unit growth is slowing down, then you can lose it, but somebody really can't take it away from you. I think Apple, you still have enough disruption because of technology change. I can't tell you what a cell phone's going to look like 10 years from now any more than anybody else can. But my guess is that people will still be using Tide detergent, a very high percentage of them, just because of the solidified position of that market share and what it does for them. There are going to be some exceptions to the rules, but those are the basic rules that I see. So that's why technology, I think, is very tough, even when somebody has a big market share, because you can have disruptive changes. And sometimes it can be just technology entering something that previously didn't have it. I mean, think of what happened to the encyclopedia business with the result of the internet. It basically disappeared. You changed the whole model of accessing information from a book to online, and the ability to change it. So that would be an example of disruption coming from technology.
If we go back to the role of management, you've stated that companies like Procter & Gamble, Coca-Cola, they can lose the market share that they have, but nobody can really take it away from them. Can you help us understand what you mean by, and what are the ways that a company like that can lose the market share?
Probably the best way I can give as an example again, if you go back to the 70s, Budweiser and Schlitz both had about the same market share in beer. I'm not a beer drinker, but as I understand, Schlitz basically found a process that made it a lot faster to produce the beer, and so they could do it cheaper. But they ended up creating a product that the marketplace didn't like, and as a result of that, there was a dramatic shift, and then it was all over. Budweiser took over the market basically, and ended up with about half of the beer market before it went public, before it went private, or before InBev in effect bought them. So here's a case where they just made a tremendous error. Coke made a huge error when they came out with New Coke, but you'll notice how quickly they adapted to that and came back with Classic Coke, recognizing that they could have destroyed the company. So again, some of these things become just making the correct decisions, and if you blow it, then recognizing quickly you've blown it and go back and improve it. I mean, look at what's happened in the last few years with JCPenney and how they had this tremendous change in business model, and it was a disaster. I don't know if they're redeemable, but we'll find out.
In a case like that, would you, it seems that there are examples of great capital allocators who have tried their hand in retail. Would you, what would you look for in a case like that in retail when it comes to management, or do you feel that you would never, could management never really persuade you, even if it had a great case for turning it around and so on, and allocating capital in a way that an investor would want? Do you feel management could ever convince you to invest in those businesses which are not your typical escalators?
Ever is a long time. Once you've reached, the question is, have they reached the point of no return? I think retailing is a tough business to begin with. It's a very competitive business. It is very difficult to create loyalty to a particular brand or style. People are really easily dislodged because of a change, a la the penny thing. And, I mean, I look at like putting Sears and Kmart together, putting two losers together, I'm not sure it creates a winner. I think it's very difficult in some businesses to do that. I know Toys R Us came out of a bankruptcy, basically, of a department store, but that was the gem of the department store, and they went on to do very, very well. So, because they found a niche and it hadn't been exploited, and they were able to do a roll-up type thing and exploit that niche. This goes back many, many years now. But so each case I think needs to be looked at independently. But I would tell you that retail is a tough business.
To move on to portfolio management, you've stated that position sizing is a function of size, price, and predictability. Would you elaborate on that and give us a sense of how you think about portfolio management with the approach that you have?
Yeah, we would like to have few stocks. One of our funds, typically with cash, and the top 10 is 50%, and the other one 75% maybe of all the assets. We think that's a much better model to have. But again, we've reached the point of size where some companies, you may reach a limitation because you own so much of the company before you get to the point where you'd really like to be, just because the portfolio is such a big size. Steve has a great point, and he said, we don't want to have more in an investment than we can make the case that if it goes down, we can buy more. So you want to leave yourself room, because nobody, again, can predict what's going to happen, what kind of event will occur to be disruptive enough to send the stock potentially down, creating an opportunity to buy more. So you like to have that ability to have that arrow in your quiver. And so that will maybe limit some of the size. But a lot of the companies we deal in are pretty large companies. And as a result of that, we can take some pretty big positions.
What have you learned from your investment in Dell, either on the security selection side or on the portfolio management side?
Well, Dell fits into that category of a situation that's a little bit more, in my mind, like a moving sidewalk than an escalator. You had a little bit of an ice cube. In other words, the PC business had reached a point where it was probably starting to lose in units. And it's a capital good as opposed to a disposable type product. So it didn't fit the mold. That's why we had a very small position in it. And we had some questions about some of the management's decision-making allocation process. But it reached the point where, when it got into single-digit territory, where it was just very cheap relative to what we saw and from an expectation standpoint and a rate of return standpoint. So we put a small investment in it, and then we had two things happen. One is the market ran up quite fast, and because Michael Dell bought the company back, it somewhat capped the upside as a result on the stock because of that, both those events occurring. So we made money on it. We made decent money on it, but we felt we could have made more.
When it comes to the size of an investment operation, we see quite a few money managers who tend to become more aggressive in asserting their rights as shareholders as the assets under management grow. It doesn't seem to be the case with you. How do you think about so-called activism, and would you consider it as a helpful tool given your investment approach?
Well, I think there are places where one can be active, and then there are limitations of it. Ultimately, like in the Dell situation, it's sort of like that old song about you got to know when to hold them, know when to fold them. You reach a point where the options just, it's not, from a practical standpoint, it doesn't make any sense to try to be more activist about it. We vote against every stock option plan. We think that's a poor way to compensate managers. We're very upfront about that. When proxy season comes along and they ask us how we're going to vote on things, we're very open, saying, hey, this is a policy we have. We will nudge managers as we, see a management. But again, there's limits. I think this is one of those cases where I think to try to influence management should be done on a one-on-one basis as opposed to through the press. I just think that try to make somebody else look bad by virtue of making some statement in the press is not a very productive kind of activity. I think we get by trying to find win-win situations, we'll get a lot further along than we will by trying to create animosity with somebody.
Now, Don, you've been in the business for decades. Tell us a bit about what keeps you going. How do you spend your day, and what do you like to do more of today than perhaps you were able to do in the past?
Well, one of the things I think that's important in life is that Monday mornings should be fun. One should be able to look in the mirror, see what you see, and try to be the best at what you can within limitations. I mean, one still has to provide for their family and some of those kinds of things. But I think the natural tendency is if we enjoy doing what we do, we'll do it better, we'll do more of it. In the case of investing, if you have fire in the belly, you really enjoy the whole process of doing what you do, then Monday mornings still are fun. They're still fun to me. And so as long as that's there, I want to keep doing what I'm doing. And I remember going to Ralph Wanger's retirement party and Leah Zell saying to him, "Ralph, I married you for better or worse, but not for lunch." So I think if I just, my wife says, "You need more hobbies." I said, "Dear," I said, "I do that all day." And, but so I think I would be a disruptive force if I were sitting around the house. So I'm better off doing what I do.
Now, what you do, and you've told us that on previous occasions, is you're an avid reader. And I was curious, what books have you read recently that you could recommend to our viewers for their libraries?
Well, yeah, I've some years ago we moved to Austin, and I travel once a week for church business down to San Antonio, and so I found myself on the highway, and I also found that I needed to stay awake, and so music doesn't do it. So in talk radio, I find just very disruptive and kind of cynical, and so I started doing a lot of books on CDs as well as audio books, and as well as reading. So I enjoy, I think what I find is it's very uplifting, even just the time to and from work as opposed to having a radio on. Reading part of the book, and it can be scriptures as well as great books that are written. I find a lot of biographies really good. Books on investing are good. I just finished one on Thomas Jefferson, John Meacham that wrote, and I thought fascinating, this human being, great human being, and also having other parts of his life that were kind of unique given the circumstances of preaching freedom and having 6 children by one of his slaves and so on, who was ironically a half-sister of his wife. But in investing, I think that I've read several books recently that are interesting and that I think can be helpful. I think your book's an excellent book, and that introduced, as I mentioned to you earlier, Joel Greenblatt and his little book on the magic formula. I think it's kind of cute. I'm not into formula investing, but I think the concepts he brings out are excellent concepts. The Outliers book that gives you case studies of management approach, I find fascinating. where it highlights the importance of being very delegative. I'm very delegative. My wife said, no, you're abdicative. But I said, look, it works. I think by creating empowered people and letting them utilize their skills, that people can really do incredible things, and with the freedom that they can have. Other books, I just in the process of finishing The Black Swan. I'm not sure I'd put that as the top of my list, but an interesting book. I think another book that I found fascinating was a book by a British author named O'Loughlin on Warren Buffett, called The Real Warren Buffett. What I liked about it, I mean, there are a lot of books that have been written on Buffett, the Snowball, which is about his history and stuff. But this one, what I liked about it was it talked about, as a subtitle, leader of men and capital allocator, two of the very, very important functions of business management. So I found those to be very, very helpful concepts really to get down.
Now, Don, you've not only succeeded as an investor, but also as a business person in your own right, building an incredible business over time. We speak to a lot of emerging managers who are so passionate about the investing side, and then other things do get in the way that then influence negatively that investing direction. What advice do you have to people, what it takes to build a successful business over time?
Well, as I mentioned, I feel the management style, and I think Buffett has illustrated that in a very diversified setting. But I think the decentralized model of empowering people underneath, not wanting to have people that are yes men, so to speak, but really give them empowerment so that they can function. In effect, I think a great leader has two qualities. One is he lets people know what's expected of them. And I'm not sure that I'm going to hold myself out as a person that's demonstrated these skills. But I think that's important, because I think people actually end up feeling more freedom when they know what's expected of them. But giving, and then getting out of their way, letting them, once you've given them the goals and the objectives and the job description effect, get out of their way as far as how they accomplish the task. Because I think people, again, when they do it more often, they go down that experience curve. They know how to do it better, and they'll become better at it than you ever would think, that you could dictate to them and tell them how to do it. And so they will feel empowered. They will be good at it. They will enjoy their job, and you will end up with a better organizational structure. The second thing is, I think, to be considerate. Whether the word is empathy, and again, I'm not holding myself out as a model of a great listener or somebody that has great empathy, but I think that being considerate, to really indicate that we care about other people, is important in life, and treat them as human beings. They're not just numbers on a sheet. They aren't just blocks, or they aren't just a piece of equipment. They're human beings, and they need to be treated as such, as one of God's children, and we're all, in my view, in the same category. We're all brothers and sisters.
Well, on that note, Don, I want to thank you so much for taking the time to share your vast experience with our audience here today.
Thank you very much.